Hello and welcome to another class in SCA 330. I'm Eunice Frimpong from Accra Technical University. And in today's session, we'll explore how deductibles and policy limits work together in an insurance contract. There is a core concept in insurance statistics, especially when calculating the insurer's liability and the insured share of a loss. So let's get right into it. In real-world insurance, it's common to see a policy that includes both a deductible denoted as D and a policy limit denoted as U. Now, here is how they work. The deductible is the amount the insured must pay before the insurer pays anything. And the policy limit, U, is the maximum amount the insurer will pay for a covered loss. So for any claim, the insurer pays up to the deductible. The insurer covers the portion between D and D plus U. And any amount beyond D plus U is the insured responsibility again. Now, this forms a three-part sharing of loss. This forms a three-part sharing of loss between the insured and the insurer. What is the maximum covered loss then? The maximum covered loss under this type of policy is given as D plus U. So if the total loss X is at least, it is greater than or equal to D plus U, then the insurer pays exactly U. Now, if D is equal to 0, that is, if there is no deductible, it means the maximum covered loss becomes just U. So losses above D plus U are not the insurer's concern. They are borne entirely by the policyholder. Now, let's define the insurance payments. We denote insurance payments as Y from our previous lessons. And we are going to explain insurance payments in a piecewise way. So we have Y taken on three different values based on the amount of loss incurred. So Y is equal to 0 when X is less than or equal to D. So once the loss does not exceed the deductible, then the insurance payments, which is what the insurer pays, is 0. So if the loss suffered does not exceed the amount of deductible, insurer is free. He pays nothing. Everything is borne by the insured. Now, if the loss is equal to X minus D, if the loss is between D and D plus U, so if the amount of loss is more than deductible, but it's less than deductible plus U, which is the policy limit, then the insurance payment Y is equal to X minus D. So the insurer will pay the total amount of loss, subtracting the deductible from it. So you just subtract the deductible, then you pay the rest. The rest is borne by the insurer. Now, the case where the loss is more than D plus U, if the loss is more than D plus U, then the insurer will pay Y equal to the policy limit. So the insurer pays only up to the maximum loss he or she is supposed to cover, the company is supposed to cover, okay? Right, so this is how we break down insurance payments in the three different instances. 0 payments for small losses, nearly increasing payments until the policy limit is reached, and then flat payment of U if the loss exceeds D plus U. This piecewise function shows how the insurer's responsibility grows and then levels off. Now, we can also write the insurance payments using a compact expression. We have Y equals minimum of X or D plus U minus the minimum of X or D. This formula is elegant and useful, especially in computational models, because it automatically captures all three cases. And it clearly shows how both the deductible and the policy limits affect the final payments. So you can think about this and reason through it to see. Generally, this is the formula, this is our focus, but this is very appealing when you are using it for computational purposes. Now let's talk about unreimbursed loss, denoted as Z, in the case of deductible and policy limits being present in an insurance contract. We define Z as being equal to X in the case where, so unreimbursed loss from our previous lesson is the amount of money or the loss that is borne by the insured. This is the loss that is not reimbursed by the insurer. So in a contract, the Z is the amount of money that the insured pays themselves. So you, the policyholder, the amount of loss involved, you bear that loss, that amount yourself. And that the variable to represent the amount of loss you bear yourself is Z. Now Z is equal to X. In the case where X is less than or equal to, Z is equal to D. In the case where the loss is more than a deductible, but is less than deductible plus policy limit. Now, you as the policyholder, Z is equal to X minus U. What you pay is the loss minus the policy limit. In the case where the loss is more than the deductible plus the policy limit, D plus U together forms the maximum covered loss. So if the loss is more than D plus U, then you, the policyholder, will pay the total loss minus the policy limit, because this U is the portion that is borne by the insurer. We now look at the expected insurance payments, the discrete case. Suppose X is a discrete random variable. Then the expected insurance payments, which is denoted as E of Y, is equal to this entire stretch of formula. That is a summation of X minus D times the probability mass function plus the summation of U times the probability mass function. So the first instance is where the loss falls between D and D plus U. And the second instance is where the loss is more than D plus U. We can write it compactly as this. This expression splits into two parts. So for losses in the partial coverage zone, that is between D and D plus U, and then also for losses that exceed the maximum covered amount. In the case where we are dealing with the loss being modeled as a continuous variable, then we say that the expected value of Y is equal to the integral of X minus D times the probability density function of X, where X falls between D and D plus U, plus so this plus in probability means or, so it's the loss either falls between D and D plus U, or the loss is more than D plus U in this case. So remember, when the loss is less than D, Y is equal to 0. So we didn't consider that instance at all. But when the loss is between D and D plus U, the insurer pays X minus D. And if the loss is more than D plus U, the insurer pays U. So each of them is being multiplied by the PDF as per the rule of integration. Yes. And then we can also write it compactly as this. So let's work through a practical example. We are given deductible D is equal to 100. Policy limit U is equal to 50. And then loss X follows a uniform distribution over the interval 0 and 2000. We want to calculate the expected insurance payment E of Y. So first of all, we define the variables. So the insurance payment Y, we'll break it down into three parts. The case where the loss is less than or equal to the deductible, the case where the loss lies between the deductible and the policy limit, and in the case where D, that is the deductible plus policy limit, D plus U. And in the case where the loss exceeds D plus U, let's go back. D is 100, U is 500. So D plus U is 100 plus 500, which is 600. So per the description we gave, we are applying the same to this example. Now, Y is equal to 500. That is the policy limit in the case where the loss is more than D plus U. Since X is following the uniform distribution over the interval 0 to 2000, where 0 is A and 2000 is B, then we know that if the PDF of X is equal to, 1 over B minus A. So we have 1 over 2000 minus 0, which is equal to 1 over 2,000. In the case where the loss is falling between 0 and 2,000, right? Because we are using the compact form as represented here, this is a survival function of x, where x is equal to d plus u. So we come here and per the survival function in the case where x is uniformly distributed, we have s of x being equal to 2,000 minus x all over 2,000. In the case of survival function, for uniform distribution, we have s of x being equal to b minus x over b minus a. So we have 2,000 minus x over 2,000, where x runs from 0 to 2,000. So given our PDF and our survival function, what is our expected value? So the expected value of y is equal to the first instance where x lies between deductible and the maximum covered loss. In that case, we expect y to be equal to x minus 100 times the PDF, 1 over 2,000, plus u, which is the policy limit, 500, times s of x, which we found to be 200 minus 600, 2,000 minus 600, all over 2,000. So solving the first term, we have the integral of x minus 100 times 1 over 2,000, where x runs from 100 to 600. And that is equal to bringing out the constant, 1 over 2,000. We have the integral of 100 to 600, x minus 100. And then we can go ahead to pursue our integration. So we go ahead to solve the integration and simplify to get our final answer. So the first part here, just this part, is giving us 1 to 5. Now the second part, we have 2,000 minus 600 as 1,004. So we have here 1,004 over 2,000 times 500, and that is giving us 350. So the expected value of y is 125, which we had for the first part, plus 350, which we got for the second part, and that is equal to 412.5. Please let's take our time to work through the integration properly. In our practical examples, I'll solve this again. There seem to be errors here. So when you are solving it, do well to check in the integration process to be sure that the right thing is being done at this point. So this means that on the average, the insurer expects to pay a certain amount of money per claim under this policy structure. Now, this average includes the partial payments for mid-sized losses and then also for large losses. The concept of combining deductibles and policy limits is key in pricing, reserving, and managing risk in insurance. Now, if you followed along till now, great job. Remember, the deductible protects the insurer from small claims. The policy limit protects the insurer from very large claims. So together, they shape how much risk the insurer is exposed to and how much the policyholder must bear. If you found this video helpful, give it a thumbs up and then share with a classmate. Thank you for watching and see you in our next lesson.